Hi, this is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And this is the first time that I'm going to include a Q&A section at the end of today's episode. So if you've got any questions for me, you can email them to me at questions@investopoly.com.au. I look forward to having a bit more interaction, I think, in this podcast by answering people's questions. Hopefully they're interesting. Hopefully I can find the right answers, of course. Okay, so today I wanted to talk about 4 alternative rules-based indexing share investment strategies. Because quite often when I talk about investing in shares in this podcast, I often make reference to or give advice to say, hey, make sure you use various rules-based, low-cost, evidence-backed indexing methodologies. And I had a question the other week from a listener saying, well, what are these strategies? Would like to learn more. Very good point. I keep mentioning and referencing them, but I've never really talked about them or defined them. So today I want to talk about traditional market cap indexing, which is a lot of people would be familiar with. But what are the 4 alternatives to traditional market cap indexing that I think share investors should consider, and certainly ones that we implement in our strategies and portfolios for clients? So let's talk about traditional market cap indexing. So the first retail index fund was launched by Vanguard back in 1976. So that's a long time ago. But, since then, indexing has grown in popularity significantly, particularly over the last 10-ish years. It now accounts for more than 50% of the managed fund market, which is a huge difference. Again, 10 years ago, I don't have the figures in front of me, but I reckon it would have been less than 10%. And it's estimated that over 15 trillion Australian dollars is invested in index funds. So, it's a substantial part of the market. So for those of you that don't understand how traditional market cap indexing works, essentially it works off a share market index. Let's use the ASX 200 as an example. And it invests in all of those 200 companies in that index, so the ASX 200, in proportion to their value versus the value of the index as a whole. So for example, BHP, if you add up all the value of all its shares, it's worth 220 billion Australian dollars, which is about 9.6% of the total value of all the 200 companies in the ASX 200 index. And so 9.6% of your money will be invested in BHP, 9.2% in CBA, 6.3% in CSL, and so on and so forth, until you own, essentially indirectly, 200 companies that are listed on the ASX. So that's just for a traditional market cap ASX 200 fund, such as A200 that Beta Shares puts together, which is, I think, the cheapest ASX 200 ETF on the ASX at the moment. So traditional market cap indexing, gives you a very broad exposure to an index or geographical market mostly. So it's very diversified and it's very cheap. The fees associated with these sorts of index funds are incredibly low, and fees are guaranteed, returns are not. So of course you should seek to reduce fees wherever possible. And traditional market cap indexing has outperformed most active fund managers. So an active fund manager is a manager that tries to pick and buy and sell stocks to try and beat the market. And they're sort of the traditional expensive fund manager that most people are probably aware of. And if you look over longer periods of time, 10, 15, 20 years, only less than 20% beat the index over that long period of time. And it's not the same 20, right? They can tend to have 1 or maybe 2 good years in a row, but the probability or likelihood of stringing more than 2 good years in a row is very low statistically. So if you're going to invest in active funds management, you've got to then work out which fund manager is going to beat the market over the next 12 months, probably then sell them and then pick the next one. And you've got to do that consistently well. Well, the analogy is it's like picking a needle in the haystack. And so the analogy is, instead of doing that, just buy the haystack. So just buy the index. Having said all that, there are 2 major drawbacks with traditional market cap indexing. The first one is that the amount that's allocated to each stock in that index is based on its current price. So as I said, if you invest in the ASX 200 index, 9.2% of your money is invested in CBA. If CBA's share price fell, it's trading at, over $125 per share today, but let's say it crashed and it fell to $80. And if you were a direct shareholder in CBA, would you sell it? Because, I mean, it's delivered extremely fantastic returns over the last 3 or 4 decades, really, almost 4 decades. So would you sell it? I mean, maybe you would, depending on what drove that significant drop in share price. But if you actually thought, well, it's temporary, you're probably, as a direct shareholder, going to hang on to it. However, when index funds reweight, and they typically reweight every quarter, what would happen is the index fund would have to sell CBA because it now makes up less of the index, and so we should sell it. Doesn't always make sense to link the allocation with price. Similarly, if we're investing in, say, an S&P 500 index fund, so that's in the US, Nvidia is the market darling. That's the stock that's, tripling in value and going nuts and so forth. It now accounts for 6.8% of the S&P 500 index. It's trading on a PE of 73 times, which is huge, right? It's ridiculous. I mean, the long-term average PE in most markets is about 16 to 18 times. This is at 73 times. So if its share price continues to climb, index funds have to invest more and more in Nvidia. Does that make sense? So the criticism with market cap indexing is that, one, you're forced to buy and sell stocks when you probably wouldn't otherwise do so as a long-term investor, just because you're following the volatility of a market. And two, it potentially exposes you to bubbles, share market bubbles, like the tech sector in the US. We keep investing more and more and more for a traditional market cap indexing fund, and it doesn't always make sense. Now, the methodology behind the market cap indexing is that the share market is perfectly efficient. That's the hypothesis, that in fact, if a share drops, if CBA drops from $125 down to $80, there's a really good reason for that, and the price reflects all the available information, and that's the correct value for that company at that time. Well, I think certainly the share market is probably perfectly efficient over the long run, but not necessarily in the short run. We see some crazy behavior with share prices and share markets, and it's obvious to me that in the short run, it's not always correct. And so following or linking our allocation with price doesn't always make sense. The second criticism with traditional market cap indexing is, as I said, most indexes reweight every quarter. Some other indexes, a handful of them might only do it twice a year, every 6 months. And what happens is the index provider publishes the reweight before it happens. And some stocks will move in the index and some stocks will move out of the index. So the stocks moving out of the index, the whole market knows that on the 30th of September, for example, Vanguard is going to have to sell its holdings in this particular company because it's moving out of the index. And so what the market does is then sort of trades on that. So what will happen is the price of those stocks will fall. And so Vanguard has to sell those stocks, for cheaper and below fair market value. And similarly, if a stock is going to be included in the index, typically the market will bid that price up and Vanguard will have to kind of overpay for that stock. And the studies show that those price movements tend to occur 2 weeks out or 2 weeks after them joining or being removed from an index, which means that Vanguard overpays for a stock, but then it loses that premium within a 2-week period after being added to the index. And essentially what that does is create a drag on returns. Now, a business like Vanguard has very comprehensive trading strategies to try and mitigate some of these things. And they do publish, their returns versus the academic index. And what you want to see is there's not too much of a difference between the index performance and the actual performance. But it's one of these things that, there are some shortcomings. And I think the primary one is the linking to price. It doesn't always make sense to do that. And so to mitigate these risks, we use alternative index strategies. And that's what I want to talk about today. And I want to present 4 alternatives to you. The first alternative is an equal weight index. So instead of, say, investing in the ASX 200 and putting 9% in BHP and 6% in CBA, let's just go and buy 1/200th, put 1/200th of our money in all 200 companies. So we invest the same in the number one company, being BHP, as well as the same amount in the 200th company, which is going to be a mid to small cap kind of stock. The impact of adopting equal weight strategy essentially means that you're going to have less exposure to large cap stocks and much greater exposure to mid and even potentially small cap stocks, depending on the type of index that you're following. And so you might use equal weight indexing where there's a high level of concentration risk in a particular index, or you do want to get access to that sort of small or mid cap market because you think it's more attractive. So let's look at the US, for example. The top 6 companies account for almost 1/3 of the index. There's a huge concentration risk, both in those companies, those 6 companies, and most of those 6 companies are all in technology, right? So then there's a huge concentration risk in a particular industry or sector. If you're going to invest in the US, you might say, look, I'll put 50% of my money in a traditional market cap index fund, like iShares IVV is a traditional S&P 500 index fund, and then I'll put the other 50% in an equal weight index, say BetaShares QUS is a S&P 500 equal weight index, to try and dilute the large cap exposure and the exposure to technology and almost kind of have a each way bet. And in that way, you're not betting on the fact that large caps are going to blow up one day. You still got some exposure, but equally you've got greater exposure to mid and small cap market in the US. So that's the example how you'd use equal weight indexing. Okay, the second one I want to talk about is what I call dimensional indexing, which is really a methodology run by a business called Dimensional Fund Advisors, or DFA. It's a US-based firm that began in the mid-80s, so it's been around for a long time, and uses a sort of very rigorous academic approach, relying on historic returns and peer-reviewed analysis to construct certain indexes to tilt towards certain sectors of the market that are more likely to generate higher returns. And when I say more likely, there's a strong amount of evidence to show that those sectors of the market produce better returns. And so they tilt towards factors like value, so how a company is valued, so it's price to book or price to earnings ratio, size, that smaller companies tend to perform better in terms of longer term returns than larger companies, and profitability. Profitability is also a hallmark of better returns. If you've got a company that generates higher profit margins compared to its industry peers, their evidence shows that those companies will produce better returns in the long run. So I'm picking on CBA in this podcast, and let me do it again. So if we look at DFA's Australian-based product, because it tilts towards value, what it means is it doesn't just go, we think CBA is overvalued, so we won't invest in it at all. It just means that instead of investing everything, we'll just invest a little bit. So DFA's Australian product uses the investable universe of the ASX 300, not the ASX 200. Now, I'm picking on CBA a lot in this podcast, but remember I said that CBA accounts for 9.3% of the ASX 200 index. Well, now because we're comparing the 300 index, CBA accounts for about 8.4% of that. So because CBA is trading on a PE ratio of 20 to 23 times, that seems high. And if you look at its book to price ratio as well, it seems high compared to historic standards, compared to its peers, compared to the industry, and compared to long run history. So it's a Dimensional's view that CBA is potentially overvalued. It's a view I think shared by some other people in the market as well, commentators. And so instead of investing 8.4% in CBA, Dimensional invests in 5.2% in DFA. So as you can see, instead of making really strong bets against, particular sectors of the market or particular companies, it's making tilts towards certain directions that history shows that it's going to produce better returns. And Dimensional has 2 ETFs on the ASX. The Australian one is DACE and the global index is DFGH, or the hedged version is DGCE. These are all in the blog on the website if you need those codes anyway. Now, I think given its approach, it's fair to probably classify Dimensional as a value manager. That's its main aim, I think, or main sort of overlay, is that it's trying to find good value companies or exclude or reduce from the index companies and industries that are overvalued. Now, I've got a link to a chart in the blog on the website, of course, that shows that over the last, at least out of 11 out of the last 16 years, growth has beaten value. So growth has had a tremendous run over the last 15 plus years and has outperformed value significantly. So when you go and have a look at Dimensional returns and you compare them to the market, well, they're not so great. They're not too bad, but certainly they're a value manager and value has underperformed. And so there's an even stronger reason to use a Dimensional approach or a value approach, because value will bounce back. And we know mean reversion will kick in at some point, and it's very likely that value will outperform. And you look at 100 years of data, value's outperformed by about 4%. So certainly value looks cheap today at the moment. Okay, the third indexing methodology I'd like to talk about is a quality factor index. So quality factor index aims to try and invest in the top X, could be 100, 150, 250 highest quality companies, and it will use objective metrics in order to identify or rank a stock's quality. And it will look at things like return on equity, low debt levels, strong cash flow, stable earnings. And typically it uses those four metrics in order to assess a particular stock's quality. And it will rank each stock in the index and then pick the top 100 or something like that. A good example of this is BetaShares QLTY. So that's a quality index stock on the ASX. It starts with an investable universe, so an index of 1,800 global businesses. It then ranks each business and gives them a sort of quality factor, and then picks the best 150 quality stocks in order to then construct an index. And then it has some rules around how they construct that index on that 150. Most of it's market cap weighted, but then they've got rules in terms of making sure they don't have too much exposure to one particular industry or one particular stock. So why would you use a quality index? Well, a quality index arguably is good to insulate a portfolio to some degree from potential economic downturn, on the basis that, if you've got a company with very strong profitability, great cash flows, great earnings history with very conservative debt levels, that arguably they can weather economic storms better than, say, a stock with, a high level of debt. And so in 2020 and 21, we were investing in sort of quality index stocks, or using quality index stocks, because if you remember back at that time, we were in the midst of the pandemic and we didn't know, how it was going to turn out and whether there was going to be a recession because of the lockdowns, etc. Fortunately, those products have generated some excellent returns, somewhere in the order of 13 to 15% per annum over the last 3 to 5 years, depending on you're looking at those products. Now, it's important to note that there's no value overlay here, right? So we're trying to pick quality companies with a quality index, but the risk is, and you need to keep this in the back of your mind, that you're investing in companies that are also overvalued. And in the long run, that's not necessarily going to work out so well. So you've got to be careful about which quality sort of factor ETFs you might use. And the fourth strategy is a value index. And it's very similar to a quality index, but what the provider will do is look at the valuation ratios of every stock inside a particular index. And they'll look at things like price to book, price to earnings, price to cash flow. And they will look at, what historically that industry is traded on, what its peers are trading on. And it'll give or try and calculate a sort of evaluation score to determine or show or reflect, whether the company is trading is expensive or whether it's cheap. A great example of this is VanEck's VLUE stock. So what that does is invests in the top 250 stocks according to their current valuation. So another way to describe it is it'll look at the stocks in the index, there's an index of 1,500 stocks, global stocks, and it'll pick the 250 that it thinks are trading at the cheapest multiples and construct an index accordingly. As I said, values outperformed growth over the last 100 years by about 4% per annum, but however, value has certainly underperformed over the last 15 years. So certainly value is very cheap at the moment, and as an investment approach, I think it makes a lot of sense, right? Yeah, I think it reduces your portfolio's risk because you're not investing in overvalued businesses, and also positions your portfolio potentially outperform in the long run as well. So just as a recap, the four were equal weight indexing, dimensional indexing, quality factor, and then value indexing. So naturally, you're probably thinking, that's great, Stuart. Now, how do I use these indexing strategies and how do I construct a portfolio using them? Now, there's over 350 ETFs listed on the ASX, and that list is growing substantially. The market is growing, and there's a huge amount of options out there. Now, we must remember ETF providers, their main aim is to get you to invest. So I think when we look at materials that ETF providers produce, we've got to have a healthy level of skepticism with what they're telling us, because, they might espouse the benefits of a particular index or thematic strategy or whatever it might be. But of course, that's their goal, is to kind of sell that product to you. Secondly, ETF providers will often backtest strategies to say, okay, if we had applied this rules-based approach over the last 20 years, how would it have worked out? I've never seen a backtest that wasn't impressive. Okay, because if it wasn't impressive, they probably wouldn't publish it. But also, it's really important to make sure that a strategy is going to work in real life, that they can implement the trading strategy and that they can track that index as close as possible. So I prefer, if a new ETF comes to market, I prefer to wait at least 12 months just to get some runs on the board to make sure it's going to work as they say it's going to work. And then in terms of picking which ETFs to use, there's a lot of considerations. You've got to look at liquidity, whether it's trading close to net tangible assets. You certainly want that to be the case. Fees, performance, the portfolio holdings and the diversification within it, the index methodology they use, the size of the ETF, because, if it's not going to attract enough money, it's not going to have any longevity and they'll close the product at some point, which means, it'll interrupt your investment strategy. Return components, so how much income versus capital growth is it throwing off? What investment process do they have? There's a lot that goes into it, and we use independent research house Lonsec in Australia to help us with a lot of that research, but meeting with the ETF providers and managers is also a big part of it. So you've got to be really diligent with which ETFs you might utilize. So how do you go about constructing a portfolio of ETFs? Look, unfortunately, it's not something that I can talk about in this podcast because it really involves kind of two aspects. The first one is experience. Knowledge is powerful, but how you apply that knowledge, you've got to learn over many years, and it's going to depend on market condition, risks and opportunities in those particular markets, and how to navigate those and when to take action and when not to take action. So experience is the first element. And then secondly, you need to dedicate a lot of time each week to, consuming a lot of charts, reviewing research, analysis. You really want to understand what's going on in a particular geographical market or segment or industry, and then that knowledge helps you choose which investment methodology best accommodates those risks and opportunity in that particular market. So unfortunately, I can't take you through this is how we would construct a portfolio because it's going to be sometimes different for every client and it's going to be different for different market conditions as well. I would say that, if you've got a relatively small investment, keep it really simple. Just use a diversified ETF like DHHF or GHHF. That's a really straightforward approach. Don't overcomplicate it. If you've got a lot of money to invest, well, then you've got to consider whether you get a financial advisor to construct and manage a portfolio for you. Of course, make sure that advisor is using the same, evidence-based, low-cost indexing approach that I've been talking about in this podcast for many years now. Okay, so a bit of a longer episode today. I apologize for that. That concludes the main part of the episode. And for the first time, I'm going to get into some Q&A. As I said at the beginning of today's episode, if you have any questions, you can email me at questions@investopoly.com.au. But let me get into 3 questions I've got today. And the first one is from Sam. Now, Sam's provided some nice feedback on the podcast. Thanks so much, Sam. But he's asked, I have a question about granny flats, specifically whether they stack up from an investment standpoint. I live in northern New South Wales, and speaking to a few local real estate agents, dual occupancy or second dwellings are apparently right up there in terms of what prospective buyers are looking for. Not sure if you've covered this in previous episode, but would be like to get your perspective on it. It's really interesting. I think if we're going to invest in property, let's go and buy the best quality property that we can afford, which is really probably a way of sort of saying, well, let's buy mostly land value and then let's buy land in an area where there's no supply. There's no supply of vacant land and there's no supply of vacant land in close proximity to where we're buying, and in an area that benefits from extraordinarily high demand. Once we've done that, then it kind of makes sense to try and derive as much income from that land as possible. Now, you don't see granny flats typically, though, in blue chip locations. That's uncommon. I wouldn't say most buyers would do that, but I've seen it in more regional areas where it's become quite common. I wouldn't go and buy a house that already had a granny flat because sometimes those properties sell on a high yield because they say, look, you're getting 2 rental income streams, and so then you're going to have to overpay for the asset. So be very cautious about that. You want to make sure that you're only just paying the price of what a standard dwelling would be. If you already have that dwelling and then you're considering, well, do I go and build a granny flat? I have had circumstances where councils have changed their mind and have said, no, you can't do that. It's got to be every property is just tenanted to one owner. You can't have 2 tenants in there. So one tenant for the granny flat and one tenant for the main dwelling. And that's caused investors problems as well when a council's made that decision. But putting aside, changes in council, if you're confident that that's what the market wants and or you plan to hold on to it for many decades, then if you can construct a granny flat and generate and potentially get close to twice as much income off that property than if you didn't have a granny flat, kind of makes sense. And you'll be able to depreciate, of course, the cost to construct that granny flat, so you'll get some tax benefits out of it as well. So look, I would say don't buy or be cautious about buying a property with a granny flat. If you've got a long-term view, then potentially you can say, look, I'll build the granny flat, whatever that might cost you, and I'll keep it for 20 years. And even if I don't get any value from it at the end of that 20-year period, other than the underlying land value, of course, no big deal, because I've enjoyed a much higher income over that period of time. So that's my thoughts, Sam. But of course, it's going to depend on geographical locations, your position, the particular market that you're buying into. Of course, there's a lot of considerations, but I hope that helps. Okay, the next question is from Steve, and thank you also for your kind feedback on the podcast, Steve. His question is regarding internally geared ETFs. I did an episode on that more recently. Specifically, he's talking about GGUS, which is a Beta Shares S&P 500 geared ETF. So invest in the S&P 500, the US index, using some gearing. He says, I'm 28 years old with an owner-occupied mortgage, an offset account, and a share portfolio. With shares, I'm aiming for a 70% core existing of broad market ETFs and 30% of diversified amongst individual shares, including some gold. If my core was made up of 3 to 4 ETFs, how would something like GGUS play a role in planning long-term capital growth? He understands from his research that there's high risk in these assets due to higher volatility, and he'd like to think of himself that has a high risk tolerance, and he's happy to ride through periods of drawdown so long as the thesis is intact for holding and potentially adding value to the ETF over time for better returns. So it's a good question. Firstly, you've gone 70% core and 30% direct. I would say forget about the 30% direct. The chances are, I haven't seen a direct share portfolio in 20 years that I've thought, gee, that's done well. Virtually every single one is either break even or loss, which consists of a couple of winners and a couple of losers. So forget about gold. You're 28 years old. You don't need to invest in gold, Steve, I don't think, and particularly not now when gold is close to all-time highs and doesn't give you any income. So I would encourage you to go 100% core. But let's get back to the question. How does GGUS fit into a strategy? Well, I mentioned this, I think, in the episode where I talked about internally geared ETFs. I don't think I'd be investing heavily in GGUS at the moment. S&P 500's trading at all-time highs. I have used GGUS both personally and professionally. I don't hold it at the moment because S&P is trading at all-time highs. I would invest in GGUS if the US stock market had a crash, fell by 20 or 30%. I'll probably start investing in a stock like that to give me greater leverage. So I'm not sure I would include it in your core. I would maybe just use a diversified ETF like GHHF, which I mentioned in today's episode, and I would just keep it pretty vanilla and just use that one ETF. Gives you full diversification. Okay, not as much gearing, but gearing across the whole portfolio then. And I think that's most likely going to achieve the best outcome. The funny thing with these questions, Steve, is how much complexity should you have in your portfolio? In terms of picking direct stocks and a bunch of ETFs, the chances are you're going to mess it up. And with the greatest of respect, of course, what I have seen, in terms of what decisions people make, chances are you're going to overcomplicate it and mess it up. Just try and keep it as simple as possible. One relatively conservatively geared, diversified ETF, and you keep doing that for many, many years, you'll beat most investors. Okay, final question is from CJ. And again, thanks so much for your kind feedback on the podcast again, CJ. I really appreciate it. Maybe this is the best part of getting these questions is the compliments. Anyway, CJ's got a sort of two-part question, but actually they're both kind of interrelated. The first part is, he says, for someone that's very close to retirement, what percentage of one's savings should be in the bank account versus superannuation? I'm reluctant to put my savings into super as I feel the money is not easily accessible as in the bank account. However, I do know there's tax advantage to putting money inside super and the investment will grow. And then the second part to his question is, from 1990 onwards, the general advice on diversification was to have 1/3 in cash, 1/3 in property, and 1/3 in shares. What do you think about this advice now? And I mention these two questions together because I think I can answer them together to say that, what I'll do is share my approach, both personally and again professionally. I like to have a asset allocation that reflects a client's risk profile. So for some people that are either very close to retirement or in retirement, I've got some clients that only have 30 or 40% in growth assets, so property and shares, and the rest then in defensive assets, bonds, hybrids, and so on. And then I've got some clients that might be 80-20, that's quite an aggressive growth. The way I like to think about it is the more that you have in growth, the more that you have in cash. And so the way that I will personally address it is that I would keep 2 to 3 years in cash and the rest of my assets are all growth, knowing that a lot of the assets, particularly shares, are incredibly liquid. If I own an ASX 200 index fund, I can sell it all tomorrow and get the money back in 3 days because that's when the trade will settle. So it's very liquid. So if it all, I really had to get the money in my bank account next week, I could, so it's not that big a deal. Now, okay, I might have to sell, the market drops 20% and then I've got to sell, that's a risk. That's why I'd have more cash. So I think the answer is keep your money invested, keep it all growth or as much growth as you are comfortable with, and then just have enough cash that is going to fund at least 2 years of living expenses. And if you're conservative, you might put that as much as 5. You might have $100,000 a year, I should say. You might have $500,000 in cash, and then the rest of your assets invested. Now, it depends on what your asset position is and how much you're spending, all those sorts of things. But just generally, that's the sort of approach I like. In terms of the allocations, that's how much cash to hold. It's going to be 2 or more years of living expenses in retirement. That's what I like. In terms of then how much to have invested in property and shares, kind of think 50-50 isn't too bad. There's no real science behind it. It really obviously depends on how you've invested over the last few years, but I'm not too really concerned about it. Obviously, if you have too much in property, you've got no liquidity, and that's a concern. But it's really around the quality of those investments. So, I'd much rather, really high quality property and very few shares, but I don't think that's necessary. I think most people can aim to have, some quality property investments and some quality share investments. And if you went 50-50 on that, I don't think that's going to look too unusual or unacceptable to a lot of people. Okay, so that's a much longer episode today, so I apologize for that. And keep your questions coming. They're really good ones. I've got some more for next week already, and I look forward to getting into them. And I'll have a go at answering as many as I can, of course. Thanks so much, and until next week, bye for now.